for agreeing to be part of this session and to address the team as well as our investors on your perspective as VCs on leasing as an opportunity for your portfolio companies. Would love, I mean, both of you are very active. You've been around people. I'm sure majority of our users know about your backgrounds, but I would love to have you introduce yourselves briefly, maybe talk about some of the work that you're doing or a few portfolio companies that you'd like to highlight, and we can, speak about them as well during the course of this session. Apul, maybe you'd like to start?
Sure. Hi, thanks again, Nikhil and Vivek for having me. A little bit about myself, got about 25 plus years of experience, mainly been on the tech side. I've done a couple of startups, been in the US for almost a decade with Qualcomm, built some exciting stuff there, moved back to India in about 2008 and have been in this ecosystem since then. Apart from a couple of startups, I've been part of a fund and have set up Gen Next Hub Accelerator. And most recently, I'm sort of the founding mentor at Brigade REAP, which is the real estate accelerator program. So I'm, just to be sure, I'm not really a VC, so to say, but I've had my own share of experience in terms of personally investing in startups, as also investing in startups via REAP. We'll talk about some of these startups, which are at REAP and which are now sort of working with GRIP. I think Clairco for sure, some of your investors would know. And there are a few others. We got Bird's Eye, Aegis, and so on. So yeah, that's about me. Mainly, I'm looking forward to an exciting session and hearing what Karan and others have to share. So.
Thanks. And, just for a lot of our investors are obviously familiar with Clairco as one of the first portfolio of one of the first companies that we leased for. I think as we'll talk about them, I think it's both Ayush and Udyan as founders have been really impressive. But I think that's also a real success story for what lease finance has been able to do. And we'll definitely get into more depth there. We're excited about partnering with Brigade REAP. Your portfolio companies really fit into the work that we can do. And probably in the next few weeks, we'll see a few more opportunities, like you mentioned, in VGOT and Bird's Eye coming onto our platform to lease as well. So thank you again, Apul.
Looking forward.
Perfect. Karan, would love to have you just introduce yourself briefly.
No, sure. Thanks, Nikhil. Appreciate you having me on this. I'm part of the team at Chirate Ventures. And we've been investing in early stage tech startups since 2006. We've invested in about 95 plus companies now. And our focus of tech companies really is anything in consumer tech, fintech, healthcare, software, and sort of affiliated areas. I've been in this role for about a little over 10 years. And spend all my life in and around technology and early stage. Very happy that a lot of our portfolio companies are working with Nikhil, with you, and hope to have many more opportunities to be able to do that. And look forward to the session.
Perfect. Thank you so much. One of the reasons I'm very glad that it's a panel that consists of both of you gentlemen is Brigade REAP and Apul, your portfolio is very early stage. And very, I would say, hardware focused in terms of the kind of solutions that we are working with. We also spoke about clean tech and environment tech, and we'll get into that. At the same time, Karan, the companies that we work with you are the companies that we work with in your portfolio are massive, Series B, Series C consumer brands, right? And I think the audience will benefit from having that perspective of that width of companies and how leasing can probably be applicable to both types of situations. And let's jump into that, right? With the objective that to provide our users an understanding of the role that lease finance provides in a company's journey, how that fits into the capital structure, and how you as advisors, as counselors, and as capital providers to companies think through the role of lease finance and what you tell your founders to do, right? So that's the broader context. I'll spend the next 15-20 minutes on a few questions that I have, and we'll then jump to Q&A from the audience. I request all members to put in their questions to the chat box, and we'll definitely pick it up in the second half of this conversation. First question to you, Karan. From if you were to look at this question from the lens of your portfolio company, could you share the experience? Maybe we are obviously familiar with RentoMojo as being a large leasee of assets, but either RentoMojo or someone else where they have taken assets on lease or through a structured product, and what has been sort of their pros and cons of that journey from their business growth perspective?
No, sure. It's a good question, and I'll give maybe an example of both RentoMojo as well as Bounce. Given that those are two companies that I know work fairly extensively with you. With RentoMojo, their business is really in the long-term rentals of assets such as furniture, home appliances, assets which have consumer durables, which have a significantly, and relatively long lifetime. These are not assets which go to depreciate to zero quickly. And what we found was, we were very early investors in RentoMojo, and as is the journey with most companies, you start by taking equity capital to finance assets, and very quickly you realize if things are actually going well, that is not the smartest thing to do, because equity is the most expensive form of capital. And if you're doing asset purchases and asset financing, at some point it will come to, really have an inefficient balance sheet in place, and you also have a very bloated balance sheet. So RentoMojo was probably one of the first tech startups, at least, to start thinking about asset financing. And what they did was, I think in the initial days, they worked with a bunch of banks that were catering to large groups of HNIs, the family offices that wanted sort of like a debt-like product. So in effect, what they did was, there was the company which procured the asset, but it was not on the books of the company as such. It was, in the name of, let's say, person X, Y, or Z, and they then, leased the asset to the company. The company then rented the asset to, let's say, myself as a consumer. And so it was really a tri-party agreement. Obviously, it was done in a simpler way. But what that did was the yield that you got from, because there is a constant return on the asset that you're getting by renting it, you're able to service the EMI on that, plus make, either a name or a yield, whatever you want to call it, on top of that. The platform keeps a certain amount, the rest goes to the asset financier. And that way you're able to ensure a certain amount of, it's almost like a fixed income product for the asset financier. And, like everything else, when you do this in small bits. And then soon you realize that, and then the second thing is, then you start doing this and you realize actually there's a lot of money to be made, and then things equalize. And so those are the three phases that we've seen it with RentoMojo, with Bounce, with others as well. For a bit, even Flyro, which was doing this for fashion rentals, did this for a certain part of their product. And that's really how, from RentoMojo's perspective in the assets, asset classes that they play, this arrangement is kind of borne out, and they're obviously doing some of that, Nikhil, with Grip in us now. With Bounce, it was a little bit different, because as that Bounce, basically, for those who are not familiar with them, are the largest platform for two-wheeler rentals in the country, sorry. And they also have a business for battery swapping. And for them, they can do asset financing in both ways, both for the two-wheelers as well as for the batteries. But let's keep it for the two-wheelers to be, to keep it simple, the same way, right? There is an asset which is more depreciative in nature compared to furniture, but it still has a longer term value. And typically for 2 or 3 years, as you're paying through the EMI, the company doesn't need to necessarily buy it and put it on its balance sheet, but they're able to avail of a asset financing structure. And then they're able to, not necessarily have to bear a lot of the upfront or capex related costs, but there is a platform which kind of takes care of that, right? And ultimately, as an investor, as an equity investor, you do this because equity capital can be put for growth purposes, as opposed to for capex or asset financing. reasons. And really, that's the summary of how this is, evolved. I summarized this in like 5 minutes, but this has taken 3-4 years to kind of get to this place. And that's kind of how we've looked at it. And I think what we're excited about is, as we go forward, many different types of assets, which could be digital assets in nature as well, could potentially also go down this route. And we'll have to explore. And I think Nikhil will, folks like you guys will be the pioneers in this. But that's really how, as venture investors, we've thought about this asset class.
Yeah, when you remove any particular name, Rentomojo Bounce, and some of the other companies in that same segment, but the way we saw it when we started this business and built this thesis is that because you're able to use non-equity capital, which is probably cheaper, the IRRs you're able to deliver on your core business as that platform and that asset renting on a B2C model is significantly higher than what you would do if you were to use your own capital to buy it, right? So to me, it's literally an arbitrage where you're using external capital for a very specific use case at a certain cost and multiplying your returns on it. And I think that's really the story behind some of this decision making. Apul would love to get your perspective on the same question.
Sure. So before I do that, before I talk about care for anybody for that matter, right? Let me just set a couple of things, right? So we are in the space of prop tech, clean tech, sustainability, and so on. And we work with very early to mid-stage startups. Now, what early to mid-stage startups don't really have is access to capital. I mean, they don't have capital because they're still building it. The real estate fraternity or the hospitality fraternity is not the one which is known to sort of adopt technology or pay premium or sort of have that money upfront for you. So you're fighting a couple of things here, right? You've got an early to mid-stage startup which has got a great idea, but let's take something like a Clairco, right? Their entire premise, when I remember meeting Ayush very early on, we just had a monitor at that time, air quality monitor, right? And from there to where they are today, where they're managing 1.5 million square feet and then some, it's been quite a bit of a journey, right? So when you are innovating, you're innovating on the tech side for sure, but you have to look at how do you build business model which also keeps up with that kind of an innovation. Now, I think one thing that Karan did mention was the equity is the most expensive form of capital. Couldn't agree more. Absolutely, right? I think this is a game of the cost of capital, right? How do I, and I always say this to startups, right? Equity is the simplest thing for you to give and is the toughest thing for you to give. It really depends upon how you look at it. And there are, especially in early stage, what we've seen is there are startups who in their because they want to get some business, because they do this, they go and they sort of raise capital and then they sort of try and put that towards working capital in terms of purchasing assets and things like those. And that's a dead as in, you put in a lot of amount of money just to acquire those assets. And then you're trying to, make money out of it. Now, more often than not, we found that really does not work, right? Because it just, that model will not scale beyond a certain point. You can do a POC or two, maybe a customer or two, and it just doesn't go beyond that. So I honestly believe, I think for this segment to sort of open up, right? Hardware is one aspect of it, right? Now, we at Brigade, I'm dealing with air, which is Clairco, water, which is WeGot, sewage treatment plant, which is Eco STP, Bird's Eye for solar energy. So it's sort of a all encompassing, encompass sort of in terms of clean tech, renewables, prop tech, and so on. Now, the other thing which I believe, I think the cash flow is another significant part which a lot of startups don't really get very well. They believe having cash is great, and I always say that cash flow is king, not cash. Right? If you get your cash flow right, the probability is you're able to really scale better, because you're able to, instead of having a 90-day or a 60-day, see if you can do prepaid, do it 15 days, 30 days, figure out a way to rotate that capital. So I think it's a culmination of access to capital without paying an arm and a leg for it, getting it quickly, an ability to then use that to scale and demonstrate traction, thereby then going and dealing with, even for an equity investor, if I go and tell them that I have traction, I've got 10 customers who are paying me month on month and I've got so many assets deployed, the probability that they would at least look at you because your business model seems to be sort of coming together is much higher. That's actually the story with Clairco. I mean, I'm sure you would have spoken to both Ayush and Uday, and I think that's the story that sort of got them to where they are, and now they are raising beautifully well. So.
Yeah, absolutely. Both of you said, that equity is more expensive, and it makes sense. And also said that when a company start, they typically use equity to purchase their first set of assets for their business, which makes sense because you have to prove a product market fit. You have to prove certain things before anyone else can come in. Given that grip provides opportunities that are largely based on younger stage companies, the question that a lot of investors may be interested in is, what is the right time to look at lease finance, right? When is a startup ready to take its first lease, and when should that comfort be, when is that enough comfort to make that decision? I know it's a tough question, right? And it's very situation specific, but if you could maybe add some pointers on it from a, or let me add one more dimension. Lease finance is about making money or having security of capital for the next 24 to 36 months, right? That's your lease term. And the way we think about it is this company going to be able to make those payments either as a function of cash or a function of cash flow, right? It's a very simple equation to us. But when we did the transaction with Clairco, they were very, very early, right? Early on. When we did the transaction with Rentomojo, they're not mature, but fairly along its way. And if you can put some contours to it without a definitive answer, I think that would be really beneficial. Apul, I don't know if you want to take a first shot at that question.
Okay, let me try. So here's the thing, right? I think see, every founder, when I meet them and if I ask them what are your 3 asks, 2 out of the 3 are get me funding and get me customers. Baki sab ho jayega, right? And I'm like, boss, I'll not get you either customers or funding. Now let's talk. Now what do you want, right? Because funding and customers are a byproduct of a of a working business model. You get your business model right, you get your product market fit right, and then you could sort of get there. Now coming to the question, when should a founder look for it? See, and since I deal most in the early to mid stage, what happens is you are still we do what we call a stakeholder development, and it's a fairly rigorous exercise that we do, which is really trying to understand what is the problem you're solving and who are you solving this problem for, right? Because most entrepreneurs believe they have the solution ready and they'll find the customers, and more often than not that doesn't really happen, right? So we spend a lot of time. Once you've got some grip on it, then the idea is, what is that particular stakeholder willing to pay you for a problem that you're solving today for them, not 6 months from now, not 3 months, but today? And who's the decision maker and what are they willing to pay? Now, why this model works, which is, sort of the grip, some of these startups working with grip, is a lot of prop tech consumers or customers of our startups or clean tech and all are not willing to bet that capital expense upfront. The VGOTS model got completely, sort of, and while they were at REAP, a lot of time went on it, Clairco same, right? When you get into that business model innovation, you realize that here is how you can actually make it work. And this is your POC, this is where you have to demonstrate. And after that, if you're able to get those points, what you need to do is raise growth capital to then sort of move on. It's somewhere in that, and you're right, it's situational, right? I can't tell you exactly, but once the startup has got their POC, they've got their POC done, they have stakeholders which are saying, hey, this works for us, I need this today, and I'm willing to pay you X for it. And they've got good margins sort of lining up, at least on the spreadsheet, because more often than not, business plan is, it's not spreadsheet, we tell them, but that's the way it manifests. I think it's somewhere there where you have to sort of look at them. And some of these actually need that support, right? I mean, I'm not trying to say be altruistic about, hey, let's support them. But if you see green shoots coming out of those kind of things, then, it's a good time for you to sort of get in, because once they get 1 or 2, and which is what has happened with Clairco, now they are sort of seemingly, and you will see that with some of the other startups. So we spend a lot of time getting that business plan to a point where everything from their revenue, margins, net margin, GMV, calls, everything, like what is it and how can it really grow and what interventions do you need? Because now you've got your customer profile or stakeholder locked. There is enough addressable market for it. And you've proved it in one or two places. You just now need to go and get this funding to get this opportunity. So they are pretty clear about, and that's the whole game of them accelerating them down that path. I hope that gives you some.
It does, and I think before I ask Karan the same question, one of the things that has played out in a few situations, which excites us, is the part you talked about, the business model and the delivery part of it. If lease finance can change the way a startup can deliver its services and make it much more attractive to the end user, which can suddenly increase the pace of revenue growth or business delivery, I think then lease finance is core to your business model, right? In which
Yes.
case it is very exciting for an investor to be coming in, a user on Grip to be coming in, because he's fundamentally changing the gross margin or the revenue growth rate of the company and the cash flow. And I think WeGot is probably a great example of that. We have a deal currently on the platform with a electric vehicle station provider, charging station provider, right? Where suddenly that ability to provide it on a lease basis or a rent basis is fundamentally changing the rate of growth of the company. And I think those are interesting cases.
So Nikhil, if I may just add one more thing, and the reason I go back to Clairco is not because that's the only company I like, but I think your investors who are on the call probably would be able to draw parallels.
Sure.
See, what happened is going from a capex to an opex. Let's say he's dealing with, let's say, a WeWork, because WeWork is their customer, right? Now, what happens is for WeWork to add that additional 1 or 2 or 3 rupees. I'm not going to get into specifics because I know their pricing, but let's say between 1 to 3 rupees, right? For them, that's okay to do because that's a monthly expense, right? And what happens is when you start looking at, hey, my customer is okay with that because that's it's like a pennies on dollars for that overall what they're selling. But if I go and tell them, hey, I'll need 3 lakhs upfront to set this up, they'll say, wait. Let's understand the math. Secondly, the approvals needed. What we've also realized is there are certain approvals that can happen at facility management level as opposed to going all the way top because it's just an incremental change. So when we spend a lot of time with these startups trying to really, really understand who the customer is, what is their pain point, and what are they willing to pay, what is their decision-making capability, all of that comes in. So one of the vectors for your investors also should be to understand that, is this business model really nice for the end customer for whom these products are being sourced? And if so, I think it's definitely a big checkbox, I would say. So.
Got it. Karan, I would love to get your perspective on this, but also hear, your thoughts on, what are the other options that are available to startups or companies at this stage to enable that trajectory, right? Equity capital plays its role very early in the journey and then can keep supporting. But I'm sure there are other structured products, debt obviously, but other structured products that may be enablers for this at a lower cost. And if you can share some of your conversations, that would be interesting.
Sure. No, and I think Apul, covered the points very well. I would say, 3 things. I think one, like you said, it's very situational. So for each company, and also, keep in mind the way the market has kind of evolved, right? This is a product which really didn't exist in our world a few years back. Whereas now it's really looked upon as a very it's a preferred way for growth from an asset financing allocation perspective. So it is very situational. And today, I think companies can avail of this much earlier than they used to be in the past. So what I still think is important, and I think Apul touched upon it well, is I think the right kind of business model for it, right? Because you need to be able to see, okay, how would this work? How does the math work, right? And if there are wild fluctuations, and I think that's what, as a investor in debt, you don't want. You don't want surprises, good or bad, by the way, right? You take the good, but you'll kind of know that you'll probably have some negative surprise coming as well, right? So if your variance in that is within a certain band, as opposed to equity investors, going in, I am going to have these wild swings and I'm willing to live with that. You want the opposite of that on there. So I think you want some of that played out in front of you, right? So you have a little bit of that history. That's one, or the second. And the third is, in most cases, I don't think this is a need in all cases. Demand should, from whatever, whether it's end consumers or a B2B customers, if it's a B2B2C product, demand should be fairly sorted, right? Even for a certain period of time. Because if you're being able to qualify demand, what you're really solving for is supply, right? And supply will come because what's lacking in the supply side is the asset financing. If, let's say, I want to finance 100 crores worth of assets, but I have the demand, I really will not want to use 100 crores of equity, even if I have it. Right? So
True.
solving one part of the equation, not both. And that more often than not, whether it's a B2C or a B2B2C model, in especially on your platform, I've seen that's kind of there, right? It's kind of, the demand is there. So I would say these are probably three things to think about. Um, what I would, and beyond that, it's sort of situational. Right? So you need to just
Yeah.
understand the specifics. Um, on your second question, look, I think equity obviously is there. Um, then you have, different forms of debt. Ultimately, you have venture debt, which has its own pluses and minuses, and we've worked very closely with all venture debt platforms. They will generally come in after there is, equity financing, because it's on the back of that. It's not necessarily for asset financing, although they've also started looking at, asset financing options separately. But typically, you would not look at venture debt. Um, as Apul said it very nicely, this is more of an OpEx financing model,
Yeah.
uh, whereas venture debt is slightly more. I would put it more for either meeting working capital, cash flow management, and capex, if needed. Um, and so the use cases are slightly different. And again, these are all getting very nuanced, which wasn't the case 2-3 years back. And you have bank debt, but bank debt is really, although the cost of capital is much lower, startups find it much harder to get there. Um, and the other one, which we've seen in a small way, and it's for a certain type of companies, it's not for everyone, is around revenue financing, right? Or supply chain financing. Now, you can't use that for asset financing purposes, but you can, as a startup or as an owner of a business, you can get that sort of capital to meet those specific financing requirements, and then be able to get asset financing requirements on top of that. But from an asset financing standpoint, I think this is, it's a use case which is very specific, and it kind of goes into the, what the requirements are. But then, to answer the question, there is revenue financing, there's supply chain financing, there is, in, like you have in your world, you have bill discounting, factoring as a form of financing as well. So all those are there, but they're slightly different and shorter term in nature typically.
Sure. And to your last point, I think it's very interesting to see these nuanced financing models come into place. And at least it is our strong belief that a company should really diversify the capital that they're taking
Yes,
based on the
absolutely.
specific use they have, right? You should take the advantage of bill discounting. You should take inventory financing, venture debt, equity, lease finance. I think each company should design its own cap structure, and that's probably the most efficient use of a plan of capital that it can have. And no one source capital meets all those requirements, right? But so I think that's an interesting to have, and I think it's interesting that fintech is headed in that direction, and a lot of companies are coming up because, as you correctly mentioned, taking bank finance is incredibly difficult. Recently, just as an experiment, we ran a deal on our platform while also approaching an NBFC for financing the same opportunity, right? Um, it was a good ticket size, good opportunity, and ultimately the NBFC said yes, but it took them almost 3 times the time it took for us to complete the transaction because of the paperwork and the processes that they have. And I think the agility or the speed at which startups hope to move, you don't want to lose business, right? If you have demand, you don't want to lose it. I think that's where a lot of the new fintech platforms can play a big role. There are a couple of questions that I thought I'll just take from the audience. Um, the first one is somewhere related to my last question, which is that a lot of these companies are also making losses, right? A lot of the ventures, a lot of the startups are still making losses. And given that there is a chance to terminate or the lease going bad before maturity, what are some of the other aspects that you may suggest to watch out for before making that decision? Right. So on the cash, Apul, if I was put in your language, the cash flow is negative of the business. The cash is what you have visibility on, and it is unlikely that you have a 24-month visibility on the cash, right? From a cash burn perspective. Is there any other markers that you would look at for making a decision to lease?
I'm still not very clear on the question. Decision to
Sure.
lease, as in for the team at Grip or for the investors to invest in this particular?
Both. I would see the team at Grip and the investors on the same side of the table. I think for us to be comfortable to list that option and for investors to then participate,
Right.
are there any other markers in a cash burning business which is burning cash?
Yeah. So, I mean, again, I mean, I don't have one right this is my perspective, my opinion, giving again early mid stage. See, there's a lot that can go wrong.
Yeah.
Right. There's absolutely that. When you're playing in this space, yeah, there is a lot. I mean, Karan can talk about equity and the bets that they take, which is even bigger, right? But this one is sort of, yeah, you're going to get that recurring monthly thing. And as the startups mature, you still have bigger startups which can fold, just because too much money came in. They thought it would work, but it just didn't, and they are leasing. So you've got startups which can fail across the spectrum. Now, what I genuinely believe is, and I think Karan did touch upon this, is the demand factor. So A, is the startup founders, is the team solid enough, right? Do you want to sort of, when you look at them, what have they done, all of that, especially about early to mid stage. Secondly, is there enough and more demand, right? Is this a problem that's growing? And are these guys applying what they have built to the right geography? And are they able to know what's their traction and so on and so forth? Now, can it go south? Of course, it can, right? In the vertical that we operate, there is I mean, I'm not saying that, but there is a perceived notion that real estate developers are not the best in terms of paying money upfront, right? One of the reasons why most startups from REIT now are sort of, what we've done is we said you have to collect money either in advance or have a SaaS model, right? So try and take care of all that can go wrong as much as you can, right? Have a SaaS. So for example, I can give you this example. One of the developers was not developers. One particular customer segment did not pay them on time, right? And they could, sort of turn it off remotely. Right? Now, what happens is, if the user is used to your service, sooner than later they would come back to you. So I think you really have to spend some time, and I think this is where I believe the Grip team can, with their experience and their connection, sort of get that right. Secondly, I also believe, and something I think I've spoken both to you, Nikhil, and to Vivek as well, is if you guys can diversify in terms of combo offers, right? So, for example, you've got, let's say, energy from a solar panel to an energy from a battery or so. I mean, may not be the best example, but a charging station in a vehicle, kind of combos that are available. Now, what happens is you're essentially hedging your bets, and even if one goes kaput, you at least have the other part returning, right? I believe those are the other thing. Third is, I think, as we come out of the post-COVID era, I think while sustainability has been a buzzword, clean tech has been a buzzword, but I've seen a lot of, at least the startups that we work with, are able to now nail down customers really quickly because A, the need is there, the business models are sort of coming up really well. And they are able to sort of, so 8 of my startups have raised funds or follow-on rounds, equity side, in the COVID months, right? Now, if they come and say, right, the credential is the team is good, is growing 20-30% month on month, has raised capital, right? These are in increasing order. So, hey, should I take a bet or not? And that's how I do my matrix in terms of if I want to invest or not. So I don't know. I mean, that's just food for thought.
No, fair enough. Karan, let me ask you the next question, which is, and I'll pose it in a different way. why should a startup or why should a company look to raise lease finance from a retail platform like Grip, right? Why not go the more in lease from a family office, lease from a maybe a fund structure, and why why would you as an investor be okay with your portfolio companies coming through a platform like this? And happy to hear that that's not doesn't make sense, it's not sustainable, but would I think that's definitely an interesting question to get your perspective on.
No, no, I think it's a great question. And I think the short answer is why not? Because what's happened on the equity investment side, so platforms like Let's Venture, AngelList, there's 100 of those platforms. I'm talking about the ones which are probably the largest. Um, that encourages not just family offices or HNIs, but again, fairly broad-based retail investors to come and invest into startups while understanding the risk. Now, I think one of the things, Nikhil, which I think you guys are solving very well for. You're solving for many things, by the way. And I think one of the things that you're solving very well for is the problem of access, right? Of being able to give people the option to invest. Now, you're giving people the option. It's up to them whether they want to take it or not. The same thing I saw happen very clearly on the equity side, right? And the challenge with the equity investment was for an AIF structure, you needed to have a certain minimum investment, and now if you do it through a different route, you don't need to necessarily have the 1 crore investment as a retail investor, right? Which is difficult for everybody to afford over a fund life of 7, 8, 10 years, whatever. So ultimately, I think it's giving people the access, retail investors access into a product where certainly risk is lower than what you would get on the investing in the same company as an equity investor. Yes, the upside is, the upside, right? It's very sort of well laid out. Um, as a institutional investor, I don't have any problem because what do I look for, right? If I'm on the board of these companies, I'm looking for what is the certainty of financing, right? Of the cash inflows coming into the asset side of it. Hopefully it's not going to be called back, and that's where knowing the quality of the platform, right, which is helping initiate and build out this kind of an investment is important, right? Which is what gives us, a lot of comfort. In our case, obviously, we know you guys, we know you very well, we know your investors, and we know our companies. So there is what people don't know is there's a lot of two-way diligence that happens, right? You call us to check on our companies,
Yeah.
we do the same. So I think as long as there's comfort, a lot of this is just based on comfort and relationships, and having that visibility into saying, yes, if this is a 2 or 3 year type of lease financing, uh, I'm not going to have any trouble with that. And, that's how you sort of ensure these things. The problem comes when people don't take, the right kind of, or don't put the right frameworks around credit risk management or compliances or, the FAQs for investors on your side, right? Which I think that's where oh, I didn't know about this, those kind of things come up.
Sure.
But and I think that's a learning process. We all have to kind of go through it.
Yeah.
And that's my view as a investor, right? Where we've worked with you guys, with many others on asset financing, debt financing. And just to answer the part of the question you said, why don't family offices and all look at that? They do, but like with everything else, investing in equity and debt is getting democratized. So
Yeah.
everybody should have access, whoever can afford to, and it's their option whether they choose to do it or not.
Yeah, perfect. And Karan, I'll also ask you the last question for today, which is around, because I know you look at fintech, is in your estimation, what is the size of this alternative investment market in the next 5 to 10 years? It's the golden question, right? And if I can share my perspective because I can't answer after you, so I might as well jump in before you. Um, we think, or whatever we've read, it seems to suggest that people will allocate close to 15 to 20% of their total portfolio to alternative investments in the next 5 to 10 years outside of real estate. This is what portfolio managers for at least the UHNI or the HNIs are now recommending. Slowly that will trickle down to a more retail or a more mass investment strategy. And within that 15-20%, we see grip as being one part of that asset, right? It's not going to be 15, 20%, but that to us is how we think about the size of the market. And I believe Indian individual wealth is currently about $5 trillion. So about $1 trillion in alternative investments is what we believe will be there in by say 2025. But
Yeah, so I think globally, and if you take debt and equity, I think, yeah, closer to that 15% is what we've also seen. Um, and I think that's kind of where we're headed towards. Now, whether it happens in 5 or 10 years, I think that's tougher to say. We actually think it's very low, to be honest, right? We were the first 10-year VC fund to have an AIF structure in India back in 2013. And so we've kind of seen it happen. We've, a lot of our LPs are investors in various forms of debt financing as well. But I also know that the level of participation is small because it is still less than 8-year-old asset class,
yeah,
right? And so people do need to see the full cycle. With debt, I think there is a lot more comfort because A, the risk is lower. B, the cycle times are shorter. So people would have seen money go in and come out at least twice by now, right? Even if somebody started in 2013, 14, these cycles are typically 3 year long, right? So you would have had 2 cycles. So I think there will always be that flight to, okay, let's start with this, understand it more, and then and build and expand. And that's where I come back to your question on the previous one. It's not just for family offices or people who've got a structured setup. It's for anybody who can afford it, who understands the risk. So we are very, very local. I mean, long story short, we're very bullish on it, both equity and debt. I think it needs a lot of platforms, like us, like Nikhil, what you guys are doing at Grip to be able to get to a fraction of that 5 trillion, right? If we get to 15% in 10 years, I think we would have done a phenomenal job, right? Because just
absolutely.
do the numbers, it's a pretty big number.
Yeah, absolutely. Perfect. Karan and Apul, thank you so much. I will, before I conclude, I will, there's one question which is lying unanswered, which is not related to the session, but I think it would be responsible of me to answer that. And both of you may not have context of this, but we recently terminated a leasing transaction on our platform. We had raised money for leasing LED screens to a company called RentoMojo. And we terminated the transaction because of certain change in terms at a last minute from the leasee, right? And that was not something that we had communicated to our investors on basis of which the capital was raised. So what we did is to return 100% of the capital to the investors, as well as a 1% penalty amount that was paid by RentoMojo to us was returned to investors in full, which effectively gave them an 18% annualized interest on that capital. But these are situations that will happen on the platform. I think we try to do our best to make sure that there is no change in terms, but at all situations protect the investor's capital and make sure that any kind of transactions are backed by proper documentation, invoicing to purchase the asset, and in case any of that doesn't go through, we return the money to the investor. So I see this as a I think investors are obviously going to be disappointed when stuff like this happens, but I will also be transparent to say I would expect it to happen again, right? The only thing investors should know is that we do our best to make sure that each of the transactions and the trust that you place in Grip is held well and then translated into the returns that you make. Yeah. Thank you again. This has been a absolutely fantastic session. I think lots of insights. This is the first session in which I was, really paying attention, because a lot of what you said is so fundamental to the business that we are building. And I think a lot for us to think about in terms of the focus we have on the kind of leasing opportunities we bring to the platform and where we can add most value to those companies and hence the right value to the investors. So thank you again for your time. Thanks to everyone who joined this call, and hope you all have a great weekend.
Wonderful. Thank you so much, Nikhil.
Yeah, thank you so much, Nikhil, and thanks, Karan. Some very insightful.
Thank you
from you as well. So
I hope this was useful for people listening in.
Yes,
I'm sure it was. Sure it was.
Thanks again, Nikhil, for coordinating this.
Thank you, Apul. Thank you, Karan.
Thank you.
Nikhil.